Welcome back to the Constitutional Clarion. This video addresses the question that I'm often asked, which is whether an Australian state can impose an income tax. For those who followed the last couple of videos about Commonwealth state financial relations that I've put on this channel, you'd know that at the time of Federation, the power to impose excise and customs duties was given exclusively to the Commonwealth by Section 90 of the Constitution. Now, these are the taxes on the importation or production and manufacture of goods. They're known as indirect taxes because the person liable to pay them passes on that amount in the price of the goods. So in the end, it's actually effectively paid by the consumer when they buy the goods because they have to pay a higher price for it. At the time of Federation, duties of customs and excise were the main source of tax revenue in Australia. This created serious vertical fiscal imbalance problems, with the Commonwealth receiving most of the tax revenue and the states having most of the spending responsibilities. To deal with that, the framers of the Constitution put provisions in the Constitution to force the Commonwealth to pass on much of its tax revenue to the states. But as shown in the previous video, that system was promptly thwarted. The consequence was that the states had to restore their tax base. They therefore expanded their direct taxes, including income taxes, to help fill the gap. By the end of World War I, the states raised most of their revenue themselves. Only 17% of their total revenue came from Commonwealth grants. While the states struggled financially during the Great Depression, their revenues later revived. In the 1938 to 1939 financial year, for example, half of state revenue came from state income taxes, and only 14% of state and local government revenue came from Commonwealth grants. The Commonwealth had also started levying its own income tax in 1915, but it was a minor tax for the Commonwealth, raising only about 16% of its revenue. During World War II, however, the Commonwealth needed significantly greater revenue to fund the war and sought to obtain it by increasing its income tax. However, it had a problem. Because Section 51(2) of the Constitution says that Commonwealth tax laws cannot discriminate between states or parts of states, the Commonwealth's tax rates need to apply equally across the whole of Australia. But each of the states imposed different levels of income tax. If the Commonwealth raised its income tax rate significantly across the country, it would have placed excessive burdens on the taxpayers in some states, but not in others. It would be much easier to just push the states out of income tax altogether and then impose a high tax uniformly across the country. The Commonwealth attempted to achieve this initially by persuasion, but the states declined to give up their income taxes, knowing that to do so would make them financially dependent upon Commonwealth grants, which of course could have conditions attached. They didn't trust the promises made by the Commonwealth that it would give back to the states income taxing powers after the war. And they were right to distrust the Commonwealth, as history has shown. The Commonwealth didn't have the legislative power to make a law that banned a state from imposing income tax. Its power in Section 51(2) to make laws with respect to taxation does not extend to laws about state taxation. But the Commonwealth still managed to achieve the outcome of getting the states to stop imposing income tax by enacting a package of 4 different statutes. One of these acts required that no taxpayer pay any state income tax until he, she, or it had paid the Commonwealth income tax first. Now, this was known as the priority provision. Another act set a uniformly high rate of Commonwealth income tax, taking away all the financial room for the payment of state income taxes. The combination of the two would mean that taxpayers would pay the Commonwealth income tax first, but many would not have the capacity to pay the state tax too, leaving the states with lower revenues and the dilemma of whether to actually bankrupt defaulting taxpayers who are residents of the state. Another Commonwealth Act then also provided for grants to be made under Section 96 of the Constitution to those states which did not levy an income tax. From an economic point of view, the states had no choice but to abandon their income taxes and accept the Commonwealth's grants instead. If a state continued to levy income tax, it would get no Commonwealth grants, receive little money from its tax, and cause great financial distress to its residents, resulting in significant political anger. The immediate effect upon the states was for their own taxation receipts to drop from 61% of their total revenue before the war to 28%, most of which came from local government rates. This reduction in tax revenue made the states much more reliant upon Commonwealth grants. The states challenged the validity of the Commonwealth's income tax takeover package in the case of South Australia and the Commonwealth in 1942, which is known as the first uniform tax case. The problem with challenging the Commonwealth's power to raise money at such a critical point in the war, when Australia was at risk of invasion, was that the High Court was not going to be terribly sympathetic to the financial rights of the states, and so it proved. Chief Justice Latham accepted that the Commonwealth had no power to make laws regarding a state's powers, such as forbidding it to enact a law imposing a tax. But he said the Commonwealth's uniform tax package didn't actually prohibit a state from imposing a tax. It didn't prevent the states from doing so. It merely offered them an inducement not to do so. Chief Justice Latham thought that the Commonwealth could induce a state, by offering money to it, to abstain from exercising its powers. He did not think that such inducement was really akin to coercion. In any case, he thought that the only remedy for such matters was through politics and elections, not the courts. Each of the Commonwealth laws that were part of this package were actually treated separately in order to determine their constitutional validity, and their validity was upheld. The Commonwealth had promised that its uniform tax laws would apply only for the length of the war plus 1 year. However, as the states had anticipated, in 1946 the Commonwealth reneged on its commitment, announcing that the laws would continue indefinitely. The states were left with a very narrow tax base, primarily estate duties, motor vehicle taxes, land taxes, stamp duties, and local government rates. In 1946, the Commonwealth raised $764 million in tax, $416 million of which was income tax, and $278 million of which was from customs duties, excise duties, and sales taxes. In comparison, the states only raised $96 million in taxes, $34 million of which was from local government rates, $16 million from estate duties, $11 million from stamp duties, and $15 million from motor vehicle taxes. The states had become substantially financially dependent upon the Commonwealth. A further constitutional challenge to the Commonwealth's takeover of income tax was heard in the High Court in 1957 in the case of Victoria and the Commonwealth, known as, and you've guessed it, the second uniform tax case. Two aspects of the package were challenged: the priority provision and the condition on the grants. The priority provision had initially been supported in the midst of the war by the defence power, which is a power which waxes and wanes depending on the level of defence threat. The question was whether, now that the war had long ended and the defence power had shrunk back to its peacetime size, the priority provisions could be supported instead by another power, like the taxation power. Chief Justice Dickson pointed out that the Commonwealth's power to impose tax in Section 51(2) of the Constitution concerns federal taxation for federal purposes. It does not allow the Commonwealth to legislate to prohibit or control state taxation. Nor did it support a provision that says taxpayers must pay Commonwealth tax before state tax. The priority provision was therefore held to be invalid. The condition on the grant was, however, upheld as valid. This was largely on the basis of prior authority. Chief Justice Dickson observed that if the interpretation of the grant's power in Section 96 was coming before the court for the first time, it would probably be interpreted more narrowly so that conditions on a grant could only relate to the need for the grant itself. However, he thought it was just too late to change course on that position. So even though the Commonwealth could not legislate to prevent a state imposing an income tax, it could legislate to make a grant to a state conditional upon it not imposing income tax. A state, of course, is always free not to accept a grant on those conditions, although financially that freedom may be illusory. While the priority provision had been struck down, this didn't actually end up changing matters. The Commonwealth's high level of income tax still took up all the capacity of people to bear an income tax, leaving no room for the states. The states had no interest in imposing excessive income tax on people and bankrupting them. So the Commonwealth continued to impose income tax while the states remained financially crippled and dependent on the Commonwealth for grants. Even when the Commonwealth Parliament repealed the grant condition about income tax in 1959, the states took no action to impose their own income taxes. While there's no constitutional constraint that prevents the states from levying an income tax, there are practical constraints. First, there would be significant economic inefficiency in requiring individuals and corporations to deal with two different income tax regimes for income earned in each state, not to mention the creation of incentives for tax avoidance. Secondly, if a state is to tax the same subject matter as the Commonwealth, that is income, then there needs to be sufficient economic room for such a tax to be applied without causing hardship or undermining the strength of the economy. In the 1970s, the Fraser government, as part of its new federalism policy, sought to implement a form of income tax sharing. Under the first stage of this policy, the existing financial assistance grants to the states were replaced by giving the states and local government a fixed proportion of net Commonwealth personal income tax receipts. The Commonwealth, however, would continue to control the rate and the base of the income tax, as well as any deductions, rebates or exclusions. This meant that if the Commonwealth granted tax cuts to taxpayers or imposed additional levies, such as the Medicare levy, that were not themselves treated as income tax revenue, then the states and local government were directly affected by a reduction in their revenue. The states were concerned about the resulting uncertainty as to their revenue, fearing that the Commonwealth would adjust the tax mix so that it received greater tax revenue from sales tax and less revenue from income tax, as it no longer had as strong a financial interest in the receipts from personal income tax. Stage 2 of the new federalism program permitted each state to impose a surcharge upon personal income tax collected within the state, or to provide a rebate of such tax. No state sought to apply such a surcharge. It was widely regarded by the public as a form of double taxation and became politically toxic. Further, the Fraser government did not make the necessary tax room for there to be such a surcharge, so it proved impractical. The laws were later repealed under the Hawke government. Later on, in 1997, when state business franchise fees were struck down as invalid because they were regarded as excises, and see my previous video on that, the states lost about $5 billion a year in tax revenue. The Commonwealth reimposed the same excises at the federal level, although of course it had to make them equal across the nation. The states became even more dependent then on the Commonwealth. The Commonwealth then decided to impose a goods and services tax in 1999. And the political sweetener to that was that the Commonwealth would transfer the proceeds to the states after deducting the costs of its imposition. The benefit for the states was that this revenue was to be free of conditions, unlike the normal Section 96 grants, to which complex and intrusive conditions are commonly tied. Although the Commonwealth sought to characterise the GST as a state tax, and probably still does so in its budget statements to stop it looking like that the Commonwealth is a high taxing government, it actually is a Commonwealth tax, and it can only be a Commonwealth tax because it imposes excises which the states are prohibited from imposing. The GST legislation states that the rate and the base of the GST cannot be changed without the agreement of all the states. But that's actually not the case. The Commonwealth Parliament has full legislative power to change the rate and the base itself whenever it chooses, with or without state agreement, as it's not capable of abdicating legislative power in this way. The states were fully aware of this at the time the GST was negotiated. Now, I know that because I was there in the room where it happened, because I was part of the New South Wales negotiation team for the GST agreement, and I did tell all the other jurisdictions that while this provision about state agreement may have some political force, it could be removed by the Commonwealth Parliament at any time without state agreement. One of the conditions of receipt of the GST proceeds was that the states abolish a number of other taxes, including bed taxes, financial institution duties, stamp duties on quoted marketable securities, and debit taxes. Other inefficient taxes were also later removed as part of the GST deal. The effect of these reforms was again to increase vertical fiscal imbalance by reducing the taxes raised by the states themselves and further increasing reliance upon the Commonwealth. Another critical problem for states such as New South Wales is that money from the GST is distributed amongst the states by the Commonwealth under an equalisation formula applied by the Commonwealth Grants Commission. If New South Wales imposes a tax itself, it gets all the revenue from the tax. But if the Commonwealth imposes a tax, like a GST, New South Wales will only get part of the money that is raised within the state, as the rest of it will go to supporting other states. So the vertical fiscal imbalance also has impacts through horizontal fiscal equalisation. So in answer to my initial question, yes, a state could theoretically impose a state income tax and keep all that state income tax revenue for itself. But for practical reasons, as this history has shown, that's not very likely to happen. Thank you once again for watching the Constitutional Clarion, and as always, I look forward to seeing you again next time. Goodbye.